Coach Jeff here today to talk about a central question to the whole real estate investing paradigm. And it's the number one question that I get asked and that I see out there on the internet. Is real estate a good investment in today's market? In other words, is it safe to invest into a housing crash or a housing bubble? Absolutely. If you know what you're doing and you practice some of the things that I'm going to teach you here on this video, you should be totally safe. And let me just start off by saying, I believe that housing is a much stabler, more, if there is such a word, it's a better and more stable investment than something like stocks, for example, or bonds, or financial products, derivatives, Bolivian pesos, whatever. These are dangerous investments because there's no intrinsic value in them. In other words, your stock market goes to zero, you've got zero left. There's nothing there for you. Housing, on the other hand, if you buy a house and everything was to go into the crapper, you'd still have that house. If the market went to zero, you'd still own that house. Stick built, brick built, doesn't matter what it is. You can go kick it, lick it, burn it. It's yours. You can do whatever you want. Well, I don't know about burning it, but nonetheless, it's yours. You can live in it. You can rent it. There's substance there. There's intrinsic basic value in owning housing stock. Now, you guys who follow me for a while, you know I'm not a big landlord type of guy. I don't like to do it. I've had problems with renters in the past, but there's a lot of ways to make money by having a rental. But the most important thing to keep in mind is the long-term value of owning the home. There's always something there. It will always generate an income. There's always some value for it, that type of thing. So let me go through kind of my 5 criteria as to why, yes, it is safe to invest into a crash or bubble. First of all, you're going to have cash flow from the rent. It may not be huge, but it's not zero. It's going to be something. So whether you buy it with all cash, buy the house with all cash, or you leverage it, by the way, you should leverage, we'll talk about that in a second, you're still going to have rental income. So even if it's 2, 3, 4, 5%, when you've got an economy that's in a recession or a depression, that's still good. Now, people will say, well, it's not as high as an 8% inflation and, our money is devaluing. Doesn't matter. I don't care about that stuff. The bottom line is it's net positive. You're going to get some money in. Yes, you got to be a landlord. You got to deal with that, but there's ways around that. You can use property managers and you can have somebody else do it, put your kids collecting the rent, whatever you want. You don't have to do it yourself. This is my bottom line. So you're going to get cash flow from it. That's number one. Number two, always buy the future market in real estate. So what I mean by that is, let's say that today the house is worth $200,000, but we know that the markets are declining out there right now. So let's say that worst case, it's going to be worth 20% less over the next 3 years. So a $200,000 house will go down by $40,000, which is 20%. So it'll only be worth $160,000. So if you buy today, knowing that, what would you do? If you know that 3 years from now, that $200 that you're going to buy it for today is only going to be worth $160 in 3 years, what would you do? Well, the answer is simple. You get it. I know you do. It's buy it at $160 today or less. And, are there properties out there? There are tons of properties. The mainstream media and all the talking heads from everybody from Zillow and Redfin to the National Association of Realtors would have you convinced that there's no houses for sale, nothing's going on. I can tell you from being in the trenches on a daily basis, there are a ton of sellers desperate to get rid of these things. And a lot of these houses are free and clear. So the chances of you buying a $200,000 house today for $160 are very good compared to what they would have been a few years ago. Now, we've been the beneficiaries the last couple of years of this pandemic increase in housing prices. They've gone up something like 41% since 2019. So, if it drops 20%, big whoop. Who cares? You still got a ton of equity. Just make sure you buy based on the future market. So estimate, anticipate, and schedule a loss in the value of the house, and then buy accordingly. You'll stay safe that way. That's number two. Number three, prices will recover, and they always do. The value of the house will recover probably within 15 years. We typically, in this country, run on what's called a 14-year cycle. So it's 7 years up, and then it peaks for a year or two, and then it's 7 years down. And that 14-year period would include this transition. So we're now in the downward slope. Prices are dropping on houses, the values are eroding, that type of thing. But where we were at the peak a few months ago, it was higher than the peak in 2007 when we were the previous peak. So it took 15 years from 7 to 22 to get back to where it was above in 7. But it did. And the only reason it didn't run a 14-year cycle is we lost a year due to COVID. So product today, house today, I tend to refer to houses as product because I look at this as a business. This is an inventory item. You have inventory of houses. We call them products. Your house price, 200 today, 160 in 3 years, 220 in 15 years, or 240 or 300 in 15 years. Housing is never going to go out of style. Everyone's going to always want a place to live rather than live outside with the squirrels and the rain and so on and so forth. Don't live in a tent. Buy a house, own a house, even if it's just for rent. That's the best way to go. So don't worry about the long-term value. As long as you're in it long-term, the house will be worth more in the future than it is today. Number 4, a renter is paying down the principal. If you rent this property out, that renter is paying down the principal for you. And the cash that you're going to get, even in the small return, is still better than a cash return you're going to get in an IRA or a bank account. Those guys are only paying like 2% now. You're going to get 3, 4, 5, 10% rent, maybe 12%, which is 1% per month. That's very usual, not unusual. And as the values go down, even if the rents drop a little bit, you're still much higher than you could get in other investments. So if you've got investment money, let's say you've got $500,000 and you want to invest it in real estate, that brings up point number 5, which is to always leverage your cash. And you can always leverage it safely with real estate versus if you were to do this in the stock market leverage, you could have a problem. You leverage your money on stocks and it goes down to nothing. You could end up owing more than you ever put out. In the case of houses, not the case. So if you got $500,000, you could buy a single house for $500,000, or you can buy 10 houses using $50,000 for each house as the 10% down payment, going to the government window vis-a-vis FHA, Fannie, Freddie, those kinds of things, getting an FHA loan and leverage that money. And now you've got 10 rentals for your whole $500,000. So it's a great investment, whether it's good or bad. As long as you've got your heads up and your eyes open, you're going to make money in real estate.